Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Here for another 2 hours this morning, like it or not. And just kidding. I know you'd love it. Wow, there's so much stuff that's going on. It is mind-boggling. I'll tell you what, man. This administration stays busy. They are busy all the time. And I don't know if you've heard about those Trump accounts that they were talking about. There's a website, and it's basically trumpaccounts.gov. It is mind-boggling. I just started looking at it this morning, and if it's so I'll have to read the whole thing. It sounds like it's fairly complicated, but it also sounds really good. Who's eligible? All U.S. children under 18 with a Social Security number are able to establish a Trump account. How much can I contribute? $5,000 a year per child. Probably not able to deduct it. They're going to have a range of funds that you get to invest in. A lot of them are very good. If they don't change it. And the funds can be accessed without penalties when the child's 18. And you can spend it on college, a first home purchase, starting a business. The withdrawals are going to be subject to some restrictions and will be taxed at ordinary income tax rate. That's a little concerning there if you're going to restrict the amount that you can get your hands on. So I'll have to check back into that. That's what I'm going to do. I'm going to spend a lot of time this week looking at this. Quite frankly, it looks too good to be true. It really looks too good to be true. So we'll take a look at that this week and come back next week, and we'll have some pretty good information for you. But it's from what I've seen, I just started looking at this morning, actually just a few minutes ago, and wow. Just mind-boggling. And you could really set your kids up. Talk about giving them a step up. You do this when they're babies. By the time they're in college, they probably have enough to pay for all their school if they wanted to. It looks like a really good idea. In fact, anything that's tax deferred sounds good to me. If I'm going to not have to pay taxes on the gains, at least not until I start to take it out. And sometimes, like a Roth IRA, you don't have to pay taxes on the gains. You don't get to deduct any contributions to it. That's why you don't have to pay taxes on the gains. And then you don't have to pay taxes on the growth of those gains. So if you've got a lot of time, that's a really good thing. And this summer, as a financial advisor, a lot of people don't understand how our industries work. If you're a financial advisor, but you're not you don't have a PTIN, professional tax identification number, that means you've gone to a school and do tax returns, and you're allowed to charge for them. If you don't go to the tax school and you don't have that PTIN, you're not allowed to give advice on taxes. And an awful lot of people don't know that, and they'll come and ask me. So I have a CPA. I love this guy, and I hope he never retires. And he's Bob Klingman's his name, by the way. And I've never seen anybody that loves taxes. And he does a ton of returns. He's very diligent, very nice guy. I also have nice people that do my accounting and bookkeeping for my business. And I didn't get their permission to use their name. I'm not sure they would get really upset, but I'll ask them. Maybe I get one of them to come on next week, because Man, I don't know too many people that have tax returns that are more complicated than mine just because of some things I did when I set it up. And I don't think that would be necessary if I were doing it in today, but you never know. Anyway, looking at the financial markets. Let's see. It's pretty wild. Even small caps, just recently, new highs. They weren't doing that well for quite a while, actually. If you looked at where the last new highs were, it was back in 2021, and they're just now barely above that. So when everybody says a new high, most people think, well, the market's really flying. Nope. Maybe not. Like, it's just barely. It's 10% ahead of where it was in the last month's. Yeah, look at it. Actually, just 10% above where it was in 2021. What year is it again? And what's really rough is I literally have to look up at the calendar because so many things have happened over the years. And so just looking at the calendar to see what day it is, I'm constantly keeping my calendar up in front of me. And I have so many memories of so much stuff. People forget the little decline we had in 2020. And then 2022, and 23, 24, the market stayed in a relatively small range. Actually, I'm talking about the small cap, Russell 2000. Okay, it's got a lot of different types of stocks in it. And mostly it's got the it's got the S&P 500 plus the next 1,500 stocks. So it's a broader index. And that's another thing. There are so many funds that have come out now. That's slowed down a little bit, but for years, they were just coming out with every week new funds, just to make it really fun and a little confusing. And there's still occasionally there's still some funds out, but some of the things that haven't changed over the years are that the basics remain the same. I've got a model I've been running for I ran it in the late, like from 2015 to 2020. And then I put it away because there were some other models that were very similar to that. Little less turnover, which means from a tax standpoint, it was a lot easier for the reporting. And but that thing's still been rocking. And it doesn't behave like people want it to behave. There's a lot of activity. So if it's not if you're not in an IRA, you probably don't want to use that one. And that one's for people that want to be as aggressive as you can be without being dumb about it. Just to be aggressive, just to be dumb, like getting a tip from somebody and going up and loading up on a stock that you really don't know a whole lot about. Not a good idea. There are, this strategy's, I think it's as far as you can go without, if you go a little any further, I think you're stepping over the line. We hold between 40 and 50 stocks in it, depending on what the stocks are doing at that point in time. And we rebalance it on a quarterly basis. And rebalance means you're going to go in, run the screen again. It's going to pick up the new leaders. And the old ones, if they're still in that list, they get to stay. But if they drop out of that top 40, then they get replaced by the new leaders. And it's a really good strategy. Actually, I just copied it off of a couple of firms that were around in the 1970s and the 80s. And these firms did so well with it, the assets under management got to such a size that they couldn't do it anymore. Their own movement was affecting the share prices on the stocks that they were investing in. So they eventually sold out to other companies. They were just acquired because they had a couple billion in assets in them a piece. So back in those days, that was, gigantic. Today, it's not what it was back in those days. So I'll put it that way. And why does that matter? Well, the reason it matters is that when you get to a certain size as a fund, they just keep taking money in as long as people keep sending it in. There comes a point when that's self-defeating. It's very difficult to manage super large sums of money, especially if you compare it to a fund that's only a couple $100 million or under $1 billion now. Can't believe I'm saying that that's a small fund. A $1 billion fund is not that big. And that just blows my mind. I just didn't think I'd live this long. But no, I'm just kidding. Anyway, what's also very interesting is that there are literally about 3,200 stocks somewhere in that neighborhood that the funds are able to invest in because they have to meet certain liquidity requirements. They've got to be of a certain size before a fund's able to own them. That's one of the reasons that private funds are so popular, because they'll go invest in companies that may not even be listed yet, not listed on an exchange. I don't want to do that personally. I'll get back to that. I'll come back to that a little bit later. But the funds will invest in stocks like that because obviously, if you could invest in Google when it first became available to the general public and nobody knew what it was, and I'm like, you don't know what that search engine is? And they know what a search engine was. And it's amazing looking back now. Everybody goes, oh, yeah, right. Everybody knows what that is. No. Everybody these days knows what that is. They didn't know what that was back when, the speeds on the internet were a fraction of what they were now. And if you tried to download a photograph, get ready, you're going to be sitting there for a while. There was no video. and man, am I aging myself. That's okay. And I remember when YouTube first came out, Google didn't own YouTube. YouTube was an independent company. And Google ended up buying YouTube. They saw the writing on the wall. That's one thing you got to give to those guys, man. They were ahead of the curve big time. But I looked at YouTube and I went, oh, man, that is such a good idea. And they went public at some valuation that I thought was just ungodly. They were paying way more than the business I thought they should have been paying for it. And that's what happens when a company comes along and the investing public, not the general public, but the investing public, all the PhDs that work for BlackRock and 20th Century and Fidelity and Vanguard, these guys are all looking at this stuff, and they've got a lot of information, a lot of data. And if they catch on early, that share price is going up way ahead of the value of the business. And that is what it's really frustrating, because you're thinking, why do they do that? And they do it because they've actually probably bought in a lot earlier, and pushing that price up gets their performance really good. And it's probably not even something that they're trying to do. I'm sure they're not, but it just happens. And then you've got this, you got to hang on to you don't have to hang on to it. As an individual investor, you'd just be hanging on to it, and it might be years before you would see a decent profit from it again. Let me pull up Google here for a second. Yeah, and I'm going back to, here's 2009, and by the way, that had been a long time. So 2009, it got to a price, it stayed for all the way up to almost to 2013, but the fourth quarter 2012. So it just went sideways. That's 3 years. And by the way, for most people, you're going to wait 3 years and not make any money on the stock, and it's going to be volatile. They're out. They don't want to wait that long. And anyway, I only got about 60 seconds here before I have to take a commercial break. So and the reason I'm talking about this stuff, and we'll talk about it more as I come back, is that if you're going to invest in individual stocks, you have to be familiar with how they actually work or have worked up to this point in time. And so I got to take a real quick commercial break, and when we come back, we'll continue with this conversation. This is Bill Bullington right here on 1420. Stay tuned. Well, welcome back. Excuse me. This is Bill Bullington here every Saturday morning, and now for 2 hours. And man, have you ever sat in a closet and talked to yourself for 2 hours? Because that's what this is like. So if you'd like to call, that would be good. 216-901-0945. And man, yesterday I was out. I was driving when the outages went out with your cell phones. A lot of people weren't aware of that, but it was completely out. And I could not believe, I was just thinking, I am so dependent on my cell phone, because I stick my cell phone in this little compartment. It's in my car, and it hooks up to my car, and it's my GPS. So the maps go from my... So I have no map. And actually, the car has one built into it as well. So I tried to switch over to that one, and I had to pull over and find a place to park. And that wasn't working. So I'm looking at the neighborhood going, I think I remember these streets somehow. But anyway, I found my way back to the highway, actually, and I had to go. I had to go take a tour of the lakefront to get back. I knew the long way home, and I didn't know the shortcuts, but because I hadn't memorized it, and I just become so reliant. And I was just thinking, man, that's got to have a lot of people. I bet I can't be the only one out there that relies on my cell phone like that, and for directions. And especially when they're neighborhoods that you're not used to going into all the time. And so that was an eye-opener, to say the least. And good thing that, when I was a kid, we lived in Brunswick. And back in those days, it was a lot smaller than it is today. But we would drive all over the place because my father was an independent contractor. And we would do a lot of construction all over Northeast Ohio. Actually, we would go all over Northern Ohio, and we hardly ever went south. That's kind of wild. But I can remember doing jobs out in close to Toledo, and on the other side, close to Pennsylvania. And hardly ever did we go far. We wouldn't never go past Brunswick south like that. So anyway, it was a blast from the past, coming back, seeing all that stuff, and it was so funny. It brought back these memories of a company called Forest City. They're I don't think they've been around for quite a while now, and they did a lot of the remodeling and building. They did a ton of building, Greater Cleveland area. In fact, for years, for decades, they were one of the biggest builders in the city, and this whole region, actually, not just the city, but several counties. And anyway, just brought back a whole bunch of memories. I was so relieved when I was able to find my way back to the highway. And I got home pretty quickly. I was surprised. There wasn't nearly as much traffic going that way as there would have been on going back the other way. So anyway, all's well that ends well. And I was thinking this morning, you know what? If I would have had a map that worked in the car, I didn't because, again, I'm relying on the cellular stuff for data. And if I'd have had a regular map, I'm not even sure that I wouldn't. I would have. I don't know if I would have been able to use it while I was driving. I would have pulled over and then look at it. And I just started thinking, man, what has happened? We have become so dependent on cell phones. That would be and then I start, when I was able to get back on the internet, I'm reading all these conspiracy theories, which you probably shouldn't do, and about our country being attacked. And I'm thinking, yeah, the first thing to do, that's right. Those guys are right. You should just knock out all the cell phone towers like lickety split. Every kid below the age of 45, they would be freaking out. They would not know what to do. And so anyway, just let's see. Those are the kind of strange thoughts that go through your mind or go through my mind whenever I'm like super highly stressed. My brain starts kicking into high gear, and all these ideas come flashing out. It's too bad I wouldn't have more ideas towards stocks, But there are tons of companies that, when I said stocks, I really meant ideas that these publicly traded companies could produce, and they do. That's another thing that I really admire about the United States. I mean, you got guys like Jeff Bezos out there. Amazon was a bookstore. That's what he first started Amazon as a bookstore. He was fulfilling the orders from his garage. And now look at him. That's mind-boggling. And only in America. Other countries are catching up. They got a long way to go. And whatever the valuations are on stocks today, at the growth rates that the ones that figure it out have, the ones they've been able to maintain, that's mind-boggling. A high growth stock, back when I first got in the industry, was like 10%. And of course, the technology came along and changed all that. And you'd have these companies growing at 30 or 40% for 10 years or longer. And that was almost unheard of. And so when they say it's different this time, they're right. And by the way, it's always been different. That's the thing about financial markets, or just the world in general. It's constantly changing. And when you're trying to invest in that environment, it helps if you have a team of people behind you that are doing a lot of the research, that are making the actual decisions. They're narrowing down the choices and helping, actually selecting the stocks that you'll invest in. You don't have to accept it, but it sure is nice that they're there. And I'm just so appreciative of the effort that the companies that I work with put into this stuff. I mean, it is mind-boggling. And these guys are nuts. No, it's just, they put an unbelievable amount of effort into it. And it always cracks me up when somebody just dismisses it. Oh, yeah, everybody can do that. Really? Let me see you do it. Come on. And everybody can't do it. And there are certain things that if you try to do it, or if you try to emulate, you try to build your own models, which is basically what I did. And I don't even use them anymore because I understood the qualities that a good model has, and now I can recognize it in what other money managers are doing. Quite frankly, there's some money managers out there that have much bigger pockets than I do, and they're spending a fortune, and their methodologies are an improvement. I mean, it's fantastic. And I'm just thankful I put all that time, effort, and energy in so that I could understand why it was working. Because if you don't understand why, the first time the market has a correction that's more than 10%, okay, you're probably going to panic. That's one of the reasons that financial advisors still have a job. You see your everything you've ever worked for, and all of a sudden the stocks are down over 10%. I think they've been down 50%. I know they have multiple times in my lifetime. And did I waver? Did I want? No. I was like, no. I knew that they had the potential to do that before I got into it. So you have to understand that. That's why balanced accounts are so popular. What's a balanced account? A balanced account's an account that has stocks, bonds, and cash in it. Okay. And some people like to say, well, yeah, there's some real estate in there too. Yes, there is. There's real estate investment trusts are going to be in your major indexes. It's a good way to get some exposure to real estate. A lot of the real estate investment trusts, you have to read the prospectus really careful on them, though, because some of them do things that you wouldn't expect. And that's another thing. If you're going to invest in a company, individual company, you better read their financial reports. You want to know what they're doing. You want to know how much the people that are running that company are getting paid. Because I've seen a ton of times where the firm made money, the CEO made money, the investors made very little. 2 out of 3 ain't bad. That's at least that's what they thought or think. And they know that back in those days, hardly anybody would read that stuff. Today, it's going to get read because you've got portfolio managers out there that are, I think they're doing a better job. So despite the fact that there aren't as many companies that are publicly traded, I think they do a much better job managing today than they did in days gone by. So and because they can, it's actually, it's a little bit easier today. You got all the data right at your fingertips. I can't believe the kind of stuff I'm able to pull up. That really surprises me, because it's not an easy thing to do, to put all that together. It doesn't really matter whether it's easy or not anymore. They've got so many people that have, and the educational system so much better, not just in America but all across the world. There are a ton of really talented people out there, and I'm glad they're there, because I'm getting old and I'm getting tired. But and I'm glad I put in all the work so that I can understand what they're saying, because not everybody does. And what's really funny in my business, the people that have a tendency to make the most money are not the ones with the best understanding. They're the best salespeople. There's a big difference. Now, if you're in sales, you probably know exactly what I'm talking about. If you're not in sales, you're probably wondering what the heck I'm talking about. And it's another reason I still have a job, for all these years. And I remember it's just doom and gloom. All the financial advisors, they're going away. They're going to be replaced by robots. Yeah, in the super long run, that's probably true. But, that takes an incredibly long time period. There's still a lot of stuff that has to be done by hand, unfortunately. And everybody's different as well. I've never met 2 clients who had the exact same risk tolerance and the exact same tolerance for the amount of taxes that they had to pay, and the same amount of knowledge. That's never happened. I've been doing this over 30 years now, and that has never happened, that somebody's identical like that. And I guess it's a good thing, God loves variety. And so I like it too. I like getting to know people, their background, what'd you do, how'd you grow up, what kind of stories do you have? Everybody's got stories, and most of them are pretty good. And everybody's had a bunch of funny stuff that's happened to them, mostly accidentally. And the more accidental, probably the funnier, unless it's tragic, and then that's not so good. But everybody's got some pretty good stories to tell, and that's one of the things I really like. I really like about this business is getting to know the people and their backgrounds, and what happened here, what you do there, and it reminds them. Anything I might say might remind them of something, or they might just come up with it on their own. It's a pretty good. It's a good way to get to know somebody, because I'm going to tell you right now, financial markets are not hard intellectually. You have to know. You have to study some about income statements, balance sheets, but it's not really all that much. And it's been formatted out there on the internet and other places so many different times and so easily. There's at least one version that you're probably going to relate to. You just have to keep reading. But that's not the hard part. The hard part for the vast majority of people is that they feel like they have to be able to predict what's going to happen with a high degree of accuracy. And the way that they're investing, they would have to do that. They'd have to predict with a really high degree of accuracy. The problem with that is you got to have a really high degree of accuracy, and this is life. That ain't happening. At least not that often. But anyway, I've only got about 60 more seconds here. I got to take a commercial break on the first hour of the Bullington Capital Report. If you'd like to call us, the number is 216-901-0945, 216-901-0945. I am going to fade out here into commercial, and I'll be back in a few minutes.
Separated until the veil was torn. The moment that
Well, welcome back. Trying to log into my password manager again. I'll tell you what, those guys have messed around with that so much. They're making it to the point where you have to do it 3 times. You think it's just because you're messing up, but when you've typed that in for thousands of times, and then it doesn't work because you're signing in 2-3 times a day, by the way. But because now it times out, and you got to sign right back in. And I think it's part of the security protocol that you do it that many times in a row before it finally lets you in, because they know that most AI software programs that are busting people's security protocols are not doing it that way. But at least they should say something about it. Okay, if you're talking to their tech support and like, I'm trying to log in. I've tried to log in like 5 times in a row. It's not letting me in. Then well, go ahead and try it now. And then, waha, yeah, it works. And it's because somebody on the other side flipped a switch. So if you're frustrated like that, I can just feel good knowing that we're all getting frustrated like that a little bit. But if it hasn't happened to you, well, count yourself lucky. But your turn's coming. But anyway, so hey, if you'd like to call in, the number is 216-901-0945, 216-901-0945. And one of the things I was going to talk about today is it's basically a management philosophy, and it's called market cap weighting. And I know a lot of you are probably familiar with it. If you know what the S&P 500 is or what the NASDAQ 100 is, those are market cap weighted indexes. And what that does, what it means is, like, say they line up all the companies and they add up all the values of all their stock. So let's say you got 2 companies. One of them's got a $100 billion market value, and another one has 50 million or 50 billion. So what they would do is they would put twice the amount of money in the one with 100 because it's twice the size of the one with 50 billion. So That's a very crude description of how that works, by the way. But it is the basics. And why do they do that? Well, that's where they feel like the market, the collection of investors is probably going to be smarter than somebody who's actually trying to pick the stocks. The smaller company may have better opportunities for growth, which they should because they're smaller, but it may not work that way. And in the stock market, it hasn't worked that way all the time. In fact, it's worked more. Let's just put more money in the more established companies, at least the ones that have the higher market capitalizations, than the smaller ones. And I hated that for years. I just thought that is not right. And I went out to build my own models because I didn't like that. And now I don't care what model that you would like to build. I'm here to tell you, there's one that's out there that's doing it. You know, if you're going to build your own models, there's some that are out there that are doing it. And I do still have a model that I built that I really like a lot. And I've got a pretty substantial amount of my growth funds in that particular model. And for me, it's just a momentum model. But for the vast majority of people, I understand it very well. I don't know that it would be something that you would want to do because of the volatility that's involved. And again, if it's not in an IRA, I wouldn't use it at all because there's a significant amount of turnover. And it looks like, that I've lost my mind. If you actually followed the transactions, you would think, holy cow, this guy, he doesn't know what he's doing. And by the way, you would also think that if you're able to open up a growth fund, an ETF or a regular mutual fund, if you were actually able to look inside and see what was actually happening, you'd probably think those guys had lost their minds. You know, it's just the way it is. It's not the way that most people think that markets go. Most people think that markets are extremely logical. And by the way, when they say logical, when they're thinking logical, they're thinking that the market thinks like they do. And they never realize that everybody is relatively unique. We all have different experiences which affect the way we think about everything. Okay. So you're going to have opinions. Your opinions are going to differ dramatically when it comes to investing. And the problem with that is it can cause problems between spouses when they get ready to retire and have never really had some serious conversations about that. And I don't know how many married couples talk significantly about the options in their 401k plans. You know, if they ever discuss that, I would, some do, but it's a fairly small percentage of all the people that I meet. It's a fairly small percentage. And I'm just thinking, holy cow, this is like one of the most important things you can do with your financial life, because you're going to be putting a significant amount of money into it over a very long time period. And it's going to end up being a gigantic portion, well, a very large portion of your retirement plan at some point in time. And nobody talks about it. I mean, they don't talk at all. And if you ask them, do you know what's in your options? They don't. They don't even know what their options are. And that is just, this is not good. And I keep threatening to try to write another book, but realistically, the way that I speak and the way that I think, I don't think I could get an entire book out of it. I think there are certain things that you have to come to grips with, and it's not really all that hard. When you've done it for a very long time, it's super simple. And that's another thing people have difficulty dealing with. They've read so much crap out there that's so complicated, that sounds so intelligent, that they're tricking you. It's not that hard. it's difficult emotionally. Intellectually, not so much. It's not an intellectual thing, it's an emotional thing. And you have to understand stocks fluctuate a lot, not a little, a lot. And they're not going to behave just for you when you retire. That market doesn't care about you. I'm putting the emphasis on the voice there to try to make a point. I'm probably making a lot of people mad. But realistically, market doesn't know you exist, and it's not there to do your bidding for you. You have to figure out how it works and then build your plan around how the market actually functions. And so a lot of the conversations that we have when we're talking about what would you like as far as what would you like to shoot for in your investment? What would be your investment goals? And an awful lot of people think I'm talking about dollar amounts. Well, that's part of it, like in percentage returns. That's part of it. Well, do you understand that for every 1% that you increase your goal by, so let's say you go from 5% to 6%, the volatility that you're going to have to accept is probably going to be 15 to 20% or so. And I mean, instead of a 25% decline, it might be closer to 40. Instead of a 20% decline, it's probably going to be 27, 28, somewhere in that neighborhood. And it doesn't seem fair. Where in life are things fair? Sometimes, and if you get lucky, then the fairness falls on you. But markets don't care. So why am I speaking about all this? Because realistically, the amount of knowledge that you would really need, you'd have to work fairly hard, but you have access to everything you would need to know. It would take you a couple of years, more than likely. And I know the young people hate that when they hear that. Not me, I can do it. And well, watch what happens the next time the market drops 50%. How you feel? I get it. I'm probably offending a whole bunch of people out there right now, but yeah, that's right. So what? Toughen up. Because you're gonna find out whether I tell you or not. Because it's just the way it is. And it's one of the reasons I never, my whole career, there were tons of times where I knew I could get new business if I was just willing to tell the prospect what they wanted to hear. Because I knew they liked me, and I knew that we would probably get along, but I just couldn't do that to get their money. Because at some point in time, you're going to find out. You'll find out how it really works. And then that could be a little bit of a problem. And so I'd rather have you hear it from me, especially if we're going to work together over the next, over years. And I've got a lot of clients now. I can't believe it. I've been with me for decades, and it's pretty cool. I really appreciate it, and I like it. And what's really nice about going forward, we have some really good tools. The tools are much better than they have been in the past. So, despite the fact that it's a little bit more challenging now than it used to be, it's gotten a little easier in some respects because of the higher power of the tools that we're actually using. And so anyway, I really get into it quite often, and I think it's kind of interesting. The AI is one of the next big thing that's coming up. By the way, if you really want, and most people don't care anything about all the philosophy that I've been talking about, and I've probably been boring them to death. What they really want to know is which stock should I buy? And all right, Well, in this case, I'm going to take my Warren Buffett hat on, put my Warren Buffett hat on. I'm going to look out into the future over an extremely long time period. But what I'm going to do that is with the benefit of hindsight. What has worked very well in the past that should, all other things being equal, if the analysis is right, which industries should be the hotter industries going forward? How much should they, what should they do? Where are the bright spots? I'm going to talk about one in particular. I'll probably be talking about this for a few minutes, and it's very, I should say surprising, because it's an old industry. Well, do you ever see a pair of clothes or some clothing that went out of style like 20 years ago, and then all of a sudden people are wearing it again? Yeah. Well, guess what? Clothing market is not the only market that does that. And what's old is new again. And I'm going to tell you right now, and all the young people are going to go, oh, it's so boring. All right, just be bored and get rich. That's what I got to say. If you got to be bored in order to make a lot of money, then be bored. And you don't need to invest in a whole lot of this. Most indexes have about 5 or 10% in these stocks anyway. But you can buy your own ETFs that focus on these, and they are utilities stocks. Boring old utilities stocks. You should see the growth rates in the utility stocks. And why? Well, because you've got these things called computers. You may have heard of them. Cell phones, cars, the average car's got about 2,000 semiconductors in it now. That's for real. It all requires electricity. I've only got about 30 seconds here. I got to take a real quick commercial break. So I'm going to tell you what the answer is. What is one of the old industries that's becoming new again, and where a lot of growth is coming from? And one of the nicest things is they pay good dividends. So, yeah, that's the trifecta. Anyway, I got to take a real quick commercial break. This is Bill Bullington. I'm right here on 1420. Stay tuned, because I will be right back.
I've tasted hopelessness. I know what heartache is, but somehow through all of it, your love remains. I've lived through brokenness, feeling faceless.
And we're back. And this is Bill Bullington. I'm here every Saturday morning from 11 to noon. I actually 10 to noon. I keep forgetting. I picked up that second hour. It's amazing how fast that goes by the way. Yeah, I was thinking, I'm going to drag. And evidently, I got a much bigger mouth than I thought I did. But if you want to call and ask a question, 216-901-0945. And you can always call us in the office. You go to my website, it's bullingtoncapital.com. And I am fascinated. The future's bright. And I remember I talk about that a lot. And overall, I'm extremely optimistic on the United States. I always have been. I can remember when I first started doing this show back in 1996. People were getting upset because I was so optimistic. Now think about 1996. You didn't have a cell phone. You had a car phone, if you had one, because they were really expensive. And you didn't have hundreds of cable channels. Most people only knew 3 networks, ABC, CBS, and NBC. That was it. Those were the big ones. So, and my point behind all this is that change is inevitable. That's going to happen. And so you've got to kind of try to find investment strategies, investment philosophies that are going to change with the times. That's one of the reasons that the S&P is so, and Russell 1000, the Russell 3000, that's why those indexes are so, have done so well and are so popular. Okay, it's built in to the algorithm. That algorithm's just it's a mathematical formula. It's built into the math that they use to select those stocks, and it is not emotional. There's no emotion in it, and that's very difficult for an awful lot of people to separate from their investing is their emotions. And I don't care. I'll do whatever I need to do. I just want to make money. That's what it's there for. And quite frankly, the better you understand it, the happier you are. Then that's a big deal. I'll probably start to do. I'll do a couple seminars this year, minimally, because I thought at some point in time, I really thought that I would educate myself out of a job. I thought everybody's going to understand this stuff. They're going to know the math, and the field that I'm in is just going to go away. And there are still a bunch of predictions that the field's going to go away. A lot of people say, yeah, nobody needs a financial advisor. Well, from an intellectual standpoint, okay, you don't have to be a rocket scientist to understand investing. It helps if you have a little bit of math, especially if you've had statistics. That helps a lot. But what it does is it just gives you the confidence to understand why markets will always come back. And it's those people that haven't done that studying that are a little upset. They get upset with me all the time because you're just rainbows and sunshine. I can't tell you how many times I had people call in and say that. No, I'm looking on the bright side because it's bright. It's really bright. You can't see it. Change is inevitable. In fact, I made this little phrase up 30 years ago when I first started doing the radio. The only thing that's constant is change. Okay, and that a lot of people don't like that. I love it. I like seeing what's coming next. Especially when I look at my life now versus what my life was like, when I was a young man. It's a lot easier. I mean, it's a lot easier. I can get more done with the same amount of effort than I could even dream about doing back then. And it's really cool. I really like it. And I look forward to seeing what happens over the next 20 years. And I'm sure that the rate of growth is not getting slower. It's actually, it's like that snowball. Just the bigger it gets, the more ground it covers, and the bigger the snowball gets. So one of my concerns is that we really need to be working on our school systems. They need money, they need help, because if the kids are going to grow up and help continue the growth that that pace that we've already set, they're going to have to be a lot more. Their educations are going to have to be a lot more intense than ours were, because everything's going electronic, and that's takes a lot of skill. I don't have any doubt in my mind that we'll do it. I think it's the rate of change that we'll achieve that it's going to have the biggest effect on the total outcomes. But it is going to get better. It's going to get better. Is it going to get better fast? By the way, that everybody that's over 60, they want better right now. I want to see that. And people that are in their 40s, like, yeah, we're working on it. We'll get there. And people in their 30s and 20s, they actually want to change pretty fast, and that's good because they make up a major part of the workforce. So we'll have that there too. And I just came in my mind. People are probably upset that I'm not talking about individual stocks, and I don't know that I'll ever. I can do that maybe next week. But it's not really the individual stocks that really matter. Trying to pick out the ones that are going to be winners, 10 years from now. You want to try to locate companies in those industries. To think that you're going to pick out the next Google, it's easy to look back and say, oh, yeah, I should have done that. Well, yeah. Just like you could look back at every Super Bowl winner and go, yeah, I should have known that. No. It's called chance. And the great news is you don't have to pick the absolute winners, and trying to do that's going to hurt you. By the way, most of this show is aimed at younger people today. Older people have experience, and they probably already know that just picking one or two is just a lot harder. Picking out a couple of super big winners and relying on that. And incidentally, anytime I've ever come across people who actually did that, and I've come across quite a few, I've only been doing this for 40 years. Yeah, but I've come across quite a few, and they were lucky. And I can't tell you how many of those people that I saw who got lucky and right up until they didn't. And then it was just tragedy. It wiping out 20, 30, 40 years of work, because it's work watching your portfolio, especially when the portfolio is done as well as theirs has. You don't really mind that work because on paper you're wealthy, and then to watch that wealth go away, man, that is just brutal. And by the way, I never opened accounts with somebody who had 90% of their assets in one stock and had gotten lucky. You know why? Because I would say, hey, this is what I would do. And I know you probably don't want to do that, and that's fine, because this is America. You're allowed to do whatever you want to do. And it was just not worth arguing with them over diversifying. And for the ones that, they did diversify, every time that the stock that they were holding did well again, despite the fact that, half the time it wasn't doing that well, going sideways or going down, because all stocks do that. That's what they do. When you're accumulating the money, you don't even notice. You probably weren't even looking at the statements back in those days, and you definitely weren't logging online to look at the account value because you couldn't. Didn't exist. And those people, by the way, they had much better returns. People that didn't look at their investment results had much better returns. I do a lot. I'm guilty of the same thing. That's why I don't look at it all that often. I can look at the market averages and give you a rough estimate of how I'm doing, because my investments are all stocks are tied to the market averages. And so anyways, I guess my point behind all this is there's no magic bullet, but what you have is pretty good. It'll get you to where you need to go. And why does it do that? Well, it's just the way that capitalistic societies are built. There are going to be opportunities. There are going to be businesses that are going to exist now and in the future. Some industries we don't even know they're going to exist yet. But you can bet when something changes, that when rockets are fairly common, when there are actually a lot of satellites going around the Earth that people are actually living on. Is that Star Trekky? Yeah, it is. But is it going to happen? I don't know. It could. I could see the value of that. I could see the value of, going to other planets. And who knows? That's the big thing. But what you really need to try to focus on is, where are you now? Where are you now? What do you need to do to get to where you want to be? If you're saving, diligently, putting no money away, great. If you're older, you're worried about spending, give us a call. if you're spending more than 4 or 5% and you're below the age of 70, you should probably try to cut that back somewhere. Try to stay somewhere between 5 and 6% at that age. And you want to use the market cap weighted strategies. There are tons of market cap weighted funds, incidentally. And that was it's been so long since I've built these models and I've been running them, and sometimes I forget. It was funny. I had some young kids, young guys. They were really gung ho about investing, and S&P's the only way to go. No, it's one way to go, and it's very aggressive. Half the money's in the top 40 stocks. Okay. Sound like it's super diversified? It's diversified, and there are some things you can do to tweak it that over your lifetime should make a fairly significant difference, mainly factoring on both size and speed, profitability. Those are three factors that over long time periods tend to matter the most. Unfortunately, you can't predict what's going to happen, especially with the profitability levels, and especially with the capitalization. It's just really tough. So you have to go with whatever is right now and focus on yourself. What do you really need to do right now? Are you able to generate enough income? And oftentimes the income is setting up a systematic withdrawal. You're going to take the money. This is what I would do. This is what I plan on doing if I ever retire. I would take the money out of the fixed income. I've got a couple of annuities too. Between the annuities and Social Security, I live a fairly modest lifestyle, and I'm happy with it. So I don't really need the other stuff that's going to go to my kids. And that's how I am. It's very simple and very easy. Not everybody's in that position. I get it. A lot of people are. A lot of people actually live very well and have a ton of money. So they don't have to worry about going over, or they don't have to worry about the 4 or 5%. They're not even spending that much. So my point to all this is everybody's different. Nobody's the same. And everybody has different ideas about stocks, what they would like to do. And that's great. Find somebody that can help you with that. There's an awful lot to know, and it changes all the time. And oftentimes it's just having the confidence. Are you doing the right things? And if you're doing the right things, and you sit down with your advisor, have a couple conversations. You could do them over the phone, or you can do them over Zoom. Which, by the way, I don't know if it's my computer's too old, because I think it's like 5 or 6 years old now. But I'm not a real big fan of that product. And anyway, bottom line is you can sit down with people, have conversations, take a look at it. If it's so complicated that you just can't understand it, don't give up. And your advisors, if you're an advisor out there, don't give up on your clients. I know it's hard. Believe me. Yeah, I talk to a lot of people, and the older that people get, the more difficult it is to be able to understand a lot of this stuff. So when you're if you're going to use an advisor, I probably wouldn't wait a whole lot past my 50s. And if you're past that, that's fine. Just talk to someone, figure out whether or not you think that that they're believable. Are they understandable? That's the key. Do they relate well? If I didn't get along with somebody, I wouldn't want to be seeing them very often. And I can't tell you how many people. I think this is really funny. I'm trying to call them, trying to just touching base, seeing if they want to get together and discuss anything. They don't call me back. and they do not call back. And I'm just thinking, you know what? I have the ability to buy and sell on your behalf, and I don't even have to call you. Okay, and if I had given somebody that kind of abilities, and they called me and left a message, I'd call them back. And but just mind-boggling, and I guess that's a good thing. I'm thankful that they put that much trust in me. But call me back. Let's see. Normally, I don't call unless I have to do something, and or just to check in because you haven't called me back for the last 3 or 4 times, and it's crazy. It's very, very difficult to keep up with. So we have a newsletter. If you're a client of mine, I have a newsletter. I send it out once a week or every other week. So every 2 weeks we send a newsletter out. Sometimes I send them, 3-4 weeks in a row, but it's going to be minimally twice a month. Newsletter's got some really nice articles in it, and it goes in depth. I pay a lot of money for that newsletter, and I'm able to pick out the articles that are going to be sent to you. And so when you get that, you can just pick up the phone and give me a call if you had questions. But I've got about 30 seconds here. I can take a quick commercial break. This is Bill Bullington right here on 1420. I'll be back after these messages. And we're back. This is Bill Bullington. I'm here every Saturday morning from 10 to noon now. And you can call us if you'd like to, 216-901-0945, 216-901-0945. Or you can reach me in my office and just go to bullingtoncapital.com. All my contact information is there. It's pretty easy. And I was just reading, I really like the guy Jamie Dimon. And that guy's been CEO for, it's unbelievable how long he's been at J.P. Morgan, one of the biggest banks in the universe. And it was a really good article in Fortune. And see, this is the kind of stuff that you really should be reading. They're doing a lot of loans on a lot of these big companies that are getting into the industries that are going to actually push the economy to grow into the future. And this guy's done a phenomenal job. Doesn't mean that doesn't make mistakes. Everybody makes mistakes. Why? Because you have to predict the future. To avoid mistakes, you've got to be able to predict the future with a really high degree of accuracy. That is not necessary to be very successful. You don't have to get each and everything right. You need to get the big ones right. And when you figure out that what you're doing is not the right thing, you got to have the willingness to be able to change. And that is, so when you read this guy's interviews, you can see that he's really down to earth, and it gives me the impression that his mind is really open. So he'll entertain thoughts. He doesn't think he knows everything. And now I understand more into why they've been so successful. And it's pretty mind-boggling, actually. This article, he was talking about his success and what he thinks has helped him. And a lot of it is listening, listening to people. He's candid feedback from all their shareholders is one of the attributes that that is contributing to his success. And I'm going to tell you, it's but you're also listening, which is highly unusual. So if you're listening and you're getting good feedback from a lot of your business partners, that's awesome. Just makes me feel better, and that's one of the things about investing too. Is there's good and there's bad, and there's your interpretation. There are going to be hard times. The good thing about this country, and the reason that I really think that the founding fathers, not of the Constitution, but of the Federal Reserve System. I always thought that was that always gave me faith that there was a God, because men are not smart enough on their own to come to that conclusion, to build something like that, especially back in those days. But they didn't have all this technology. And the reason that we have a lot of this technology is that it was financed. And it's financed through fractional reserve banking system. That's pretty good. It's worked very well. We didn't invent it, incidentally, and other countries around the world had been using it. We were just bigger than they were for a very, very, very long time period. And even Russia and China are semi going that route. And in some cases, China's got an advantage because their leader's a highly intelligent guy. And it's a lot easier to make decisions if you only got one person to convince. And I could be totally wrong on this, so don't hold my feet to the fire over it. But it seems to me that he may not be delegating, and he may be looking at it. And I'm sure I'm sure he's intelligent enough to, if he really doesn't feel like he understands the whole problem, that he's got people there that he relies on that can get him up to speed so that he can make a decent decision. In the United States, that's called Congress and the Senate and the President. And for a long time, it worked very, very well. As long as they respect each other and get along. When there's chaos, we're not making a lot of progress. There's not a lot of progress. Well, the progress has slowed down. And if you think that you can make better decisions than all the other people that you're receiving information from, I think you have another thought come. It's not a matter of if, it's when. And you'd hope that if a leader made a decision and it turns out not to be a good one, you don't defend it and keep trying to push it. At some point in time, you got to say, okay, well, yeah, that didn't work. So what? And that's one of the things I think the general population has a tough time thinking that these guys are going to be perfect all the time. No, nobody's perfect all the time. Nobody. So you got to cut them some slack too, so they're not afraid of making tough decisions. It's in other words, it all works together. And this has worked incredibly well for an incredibly long time period. And man, when I'm looking at what's happening, I'm kind of envious of my grandkids, because I know what they're working on right now. And by the time they're in their mid-30s, the world's going to be a different place, and it's going to be better. It's absolutely going to be better. And so I'm very excited for them. Most of those companies that are making those changes are publicly traded companies, so they are going to benefit from that. Anybody investing in stock funds is going to benefit from that. And is it going to be straight line? Heck no. It's never been that way. And you have to give that idea up. That idea was born from some financial advisors that didn't want you to know any better, and they don't realize that you can go look this stuff up now, and they're still, using the same stories. Yeah, it's just straight line. No. By the way, I haven't seen that for a very long time period. Most of the advisors that are out there today are a little smarter than a lot of the ones in my generation. And they're not trying to tell you exactly what you want to hear. They're trying to tell you the way it is, which is how I've been my entire career. And yeah, it's cost me money to operate my practice that way. I could have taken the money, got paid, and said, whatever. But I just have a really tough time doing that. I have a tough time letting people invest in things that I know that they don't fully understand, which is not easy, because some of the better products that are available out there are complicated. And I'm telling you, there's a fixed indexed annuity I love. I got a fairly substantial portion of my money in there, but it's complex, and it's not for everybody. In fact, some people, and it's not the math. It's not like the wrong investment. It's their mentality. It's the way that they see things in this world, and it's not necessarily wrong. In fact, it's not wrong. It's just how they are. Okay, if you're not going to be happy, then you need to find the investments that are going to make you happy. Now, when I say that, I'm going to get calls. People say, "Yeah, I don't want much. I just want 10% a year, tax-free, with no risk." Yeah, you and everybody else on the planet. If you could do that, if I could find a product that would do that, I'd only be working for about 2 more weeks. And anyway, the good news is you can probably find something that you really like. And if you like stocks, we've got one of the better stock programs I've ever seen. We have access to it. I'm not the one that runs it. Somebody else runs it. But if I had the money, it's exactly how I would have set up my infrastructure to be able to select. And by the way, there are tons of index funds, which I feel like are extremely close in that market. In fact, the diversification that you can get through various funds is a lot higher than what you can get in my other favorite investment philosophy, which is buying the stocks based on their underlying fundamentals and managing them. Both of those make a lot of sense. And then my third favorite is it's the most aggressive, and it's the one that I've got the least amount of money in, but it's still pretty substantial. And it's a speed, size and speed, which is exactly what the S&P 500 is. It's size and speed. They're the top 500 companies who are going up the fastest. And if you're an advisor out there and you don't get that, call me. I'll tell you what I mean by that. And for the rest of you guys, the reason that I'm saying size and speed, well, when you measure by capitalization, that's the number of shares times the share price. Okay, so if you had 1 billion shares and you're selling for $20 a share, that's $20 billion. That's your capitalization. They put more money in the bigger ones, just assuming that they're going to do better than the smaller ones, and they don't actually say that. They just tell you this is how we're doing it, and it's done very well for an incredibly long time period. In fact, it's very difficult to beat. Okay. But what happens occasionally is the stocks, if they get ahead of themselves, that's happened a couple times during my lifetime, where the valuations, the prices that the stocks were selling for was ahead of the actual value of the underlying business by a lot. I remember that 2003, I was thinking, holy cow, man. To be a normal valuation, stocks would have to continue this growth rate, about 40% a year, at a 40% a year rate for about 10 years. Okay. And that the likelihood of that happening was so low, and everybody was so upset that I kept telling them, no, we're cutting back. I cut back to 70%, and I got flack from my brokerage firm. You can't time the market. I'm not timing the market. I'm looking at the valuations on these stocks, and they're not worth what they're selling for. And they were clamping down on me. They were trying to hold my feet to the fire. In some of the areas that I worked in, they were able to successfully block me from being able to reduce the stock holdings. That's one of the reasons that company doesn't exist anymore. That's another thing that gave me a little confidence after I'd left. They just did not exist after that. They ended up having to sell out to another firm because they had a lot of litigious activity going on. I'll just put it that way. And yeah, it's kind of interesting. The overall, it's not all that difficult. What is difficult is putting up with the volatility. That's difficult. What's difficult is keeping your morale, your energy at a high level. That's difficult. I'm not going to kid you. The very difficult to be thinking in terms of long term, especially when you get up in your 80s. Okay, but I got news for you. Market doesn't care how old you are. It doesn't care. And when you have to make adjustments, and you have to know yourself. Do you think you can put up with a 50% decline in the value of the stocks that you have? And that's where an advisor can really come in and help. How much do you have in stocks? How much do you have in bonds? What are your income needs? How much income are you taking? And there's no magic formula for that, by the way. It's a one-off basis. I've never met two people with the exact same conditions, with the exact same risk tolerances. Okay? And married couples, oftentimes it's very different. And educational levels, that's probably the hardest one, because anybody that's like 65 or over, they didn't teach this stuff when we were going to school. It's just they didn't. I had a couple of years of finance, and I majored in economics in college, and they didn't teach any of this. It was not very practical. Now I'm hoping that in these days that they do. And incidentally, the most arrogant, and this hasn't changed at all over the past 40, 50 years. The most arrogant investors are the ones that know the least. And but they're convinced they do. And it doesn't really help to argue with them. I basically ask them a couple questions like, hey, what's the price to sales ratio of the S&P 500 right now? And they look at me like, what? Now that I've been saying this for quite a few years on the radio, and I can't believe that people call in and they still and I get it. It's actually part of it is that they're not all arrogant. A lot of them are just afraid. They're scared. They've seen the numbers, and it is spooky. I mean, the amount of money that you have to accumulate. You look at the financial plannings talking about the 4% rule. Well, don't try not to spend more than 4%. That's what you start at. You're going to start off with 4% withdrawal rate from your savings for retirement. Somebody's only got $100,000 saved. That's a problem. That's 4% is only $4,000. I think, but I have $100,000. Yeah, but see, if you spend more than 4%, markets have a tendency to go down and take 10 years or longer to make back up again. And when they're going down, that 4% that you're taking out turns to 8%. The markets drop in half like they did twice in the last 20 years. And you're typically not quitting taking money out. That's one of the reasons that annuities are so popular, is because you get a guaranteed income and it stays. It doesn't matter if your money runs out. The insurance company still has to pay you, until you die. And if you put a joint owner on there, it's joint with rights of survivorship and a joint annuitant, and they're going to pay until both of you pass away. So for you married couples, if you're interested in it, and the rates are pretty good. They're very good. I'm going to say the average person will never be able to guarantee and match what the insurance companies can in that type of a product. Now, they are restrictive. Can you get your money out? Well, you can, but you can't do it without some sort of penalty for the first, I think 9 or 10 years, depends on the contract. Some of them are a little bit less, some a little bit more. And I got to take a real quick commercial break. This is Bill Bullington right here on 1420. I'll be back after these messages. we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 10 to noon now, like it or not. But I'm going to be staying here. If you want to call in today, the number is 216-901-0945. And I'm going to go right to the phones now. And Lola.
Yes, hello.
How are you?
Fine, how are you?
Pretty good.
So I have a question. So my parents owned many businesses, and they're in their 90s, so they lumped all the businesses into an family LLC.
Right.
And there's 6 siblings, and 3 want to stay in the LLC, and the other 3 of us want to be bought out.
Right.
But it didn't file to where we are in possession of it. So what is the best way to receive that buyout to avoid the least tax? To get the least tax on it?
You need to talk to CPAs who specialize in that sort of thing. And if you want to call me during the week, I can give you the firm that I work with, because they do a lot of that kind of work. But that's pretty highly specialized, and you do.
Okay.
Yeah, it changes quite a bit from year to year. So you want to make sure you're dealing with somebody who specializes in that, because there's a lot of bad information out there.
Correct. And I remember on your show you say how the IRS can change things like month to month sometimes.
Oh,
so,
man, it is mind-boggling. I wish they would have never learned how to use computers.
Yes.
But yeah, so if you want to call or write in or this week, I can give you the contact information.
Okay.
And I'll call them ahead of time and let them know that you're going to be giving them a call.
Okay, that sounds good.
Yeah. Well,
yes, because we're very confused. They just want to write us a check, and we're like, wait a minute, because there's so many different taxes that might apply to that
right.
Maybe there's some we can take advantage of not having imposed on us.
Right. Yeah.
Okay.
You definitely need a specialist for that.
Okay. So, I look forward to this week then. Thank you.
Okay. Thank you. Bye-bye. Yeah. So if anybody else has a question like that, you can always go to my website and send it in. I'll send you an email, and I really like the accounting firm I've used. I've used them my entire career. They've got a bunch of younger people there now, so that's kind of cool. Because I know they're up on all the latest trends and what they got to keep up with, which is a lot. I can't tell you. I took the H&R Block course like 25 years ago. It was hard then, and almost everything has changed over that time period. And so we give investment advice. Fortunately, we have that firm that we're working with. It's called ID Bailey, by the way. Just a free shout out. And I have also an individual that he's a tax preparer. He's got the highest designations you can get in tax preparation, and he really loves that kind of stuff. I'm glad somebody does. Yeah, I am. It just bores me to death, and it's all a bunch of unbelievable amount of knowledge or rules that change every year. And we just got some big changes, and I forgot to bring that in with me. It was on the 529 plans. They're making it so that they have some pretty interesting options there. And so maybe I'll get it together and talk about it on next week's show. I've got about, probably about 6 or 7 minutes left. If you hear something on this show that you'd actually like to talk about, you can always go to my website. It's bullingtoncapital.com. And I'll be glad to try to reach back out to you. That I have to tell you that this time of year is generally pretty busy for us. It'll stay that way right until after tax time. So if it takes us a little bit longer to get back, in the best times to call really in summer, because then nobody wants to talk. So it's a lot easier for me to follow up on the inquiries at that point in time. And having said that, I was just looking at there's an article, and they were interviewing Jamie Dimon, and this is in Fortune, And I really like that guy. The firm, that he's the CEO of. He really speaks openly and honestly. At least I think he's honest, because a lot of the stuff that I've heard him talk about, I watched, and it's like happened just like he said it would. But so it's pretty cool, and I'm a big fan. He was talking about he very down to earth. I was talking about Bitcoin, and I remember Bitcoin. There's been a lot of good information, a lot of bad information. But anyway, someone asked him how he felt about Bitcoin, and he said, not talking about Bitcoin, but Bitcoin uses blockchain, and that's what he said. Was he didn't make the differentiation. He just said blockchain is real. Stable coins may have real use. We have the JP Morgan coin. Tokens will be real. Programmable money will be real. He's not going to say about Bitcoin specifically, because then he gets, death threats. He was talking about that, and that's what happens. Blockchain and Bitcoin is not backed by the federal government. Okay, so you're essentially trusting a facility, and this is I don't invest in it. And why? Well, because the Federal Reserve stands behind the bills I have in my wallet. They'll cash them, and they've got big, huge reserves of money, and they're legally licensed to print more money. And that's what Bitcoin is trying to do. But I have no idea who's standing behind Bitcoin. And if it were to all go down tomorrow, how would I be able to prove that I ever had it? It's all digital. If it went away, or if they just said, "Hey, sorry, we're not going to pay you," sorry about your luck. Yeah, who do you sue? And it's all based on trust, and everything. Ultimately, everything is based on trust. The Federal Reserve, you might have heard of them. They're using a computerized system now since the late 60s. It's very similar. That's what gave somebody the idea to do Bitcoin. Well, let's just do our own. We're going to do our own currency. And we'll do loans, and we'll exchange. We'll set up an exchange. And this is all done by people. And one of the things that bothered me was like, well, it's all secret. We won't tell anybody that you have money there, and we won't tell anybody that anybody has money there. So when you're doing when you're making exchanges, that's between you and the counterparty, but we won't give anybody any information on either one of you. Well, if something goes wrong, where do you go? That was my from the very beginning. I mean, the very first time I heard about it, well, that's dumb. And I can't remember, but somebody I know got burned like big time in a Bitcoin scam. See, that's why because you got nobody to complain to. Somebody steals money out of my bank account. First place I'm going to go is to the bank, and say, hey, and then if they don't, I'll go to the banking department for the state of Ohio. Say, hey, I had this money, and they took it, or somebody took it. And anyway, that infrastructure has been in place for an incredibly long time period, and there's an order there that they have to follow. All bankers have to follow, and there are legal ways to enforce those rules that they're operating by that Bitcoin didn't have. Bitcoin had a lot of rules, but they didn't have them all. And that's what I was thinking of at the very beginning. I'm like, I'm not giving them my money. Are you kidding me? All they had to say is, hey, oh, sorry, we can't, we went bankrupt. We don't have your money anymore. And I'm like, in this country, you got the banking system that stands behind it, and you got a potential bailout from the federal government. Now, is that perfect? No, but it's the closest you're going to get. And I'd much rather have the United States government with all the revenue that they get from all the taxes that they collect standing behind something. And I know, yeah, I'm oversimplifying it a little bit, like a lot of bit, but but anyway, it's all about confidence, and I just didn't have any confidence in it. So, and I don't mean to say I know some people, a lot of people have gotten burned by similar other Bitcoin type of organizations, and I feel bad because it sounded really good, and I was very interested in it at first, and then I'm like, wait a minute, this is like loaning money to your cousin. You're taking their word for it. And what happens if they just shut down? Sorry, ran out of money. In this country, when your bank makes loans that don't get paid back and they have to shut down, the Federal Reserve steps in and makes you whole. At least, up until you meet the maximums. That's another thing you have to be aware of, that you have money on deposit at a bank. It's not all 100% insured. Then insurance only goes up to a certain dollar amount. So, be careful of that. That's one of the reasons. If you got a whole lot of money, you probably just want to buy treasuries. And you can buy treasuries from most brokerage firms. I use Fidelity because they're huge, and they do more fixed income transactions than 95% of all the other financial institutions. So it's hard to get much better than that. And you can also go directly to the Fed and open up an account, buy T-bills and that kind of thing. So at some point in time, we'll come back to those subjects. But anyway, I did really like what Jamie Dimon had to say about the Bitcoin and what everything in the article that had to do with that. There wasn't like a ton. This was really more of a general article, and I just think that guy's he's just, it's unbelievable how smart he is, and we're very lucky that we have somebody like him in this country running one of the biggest banks that's ever existed, and I'm sure that's how he had a large part to do with growing that facility. So anyway, I really apologize today for all the stammering and stuttering. It's just I'm getting old. And I take an awful lot of questions all the time, and they don't always, I would say probably the majority of questions that I handle in my office are not really about their accounts. In my office number is 330-664-0700, 330-664-0700. So if you want to call me and ask me questions, feel free. And thanks a lot for listening this week. And thanks a lot, Lenny, for reminding me that. And this is Bill Bullington. I'm here every Saturday morning from 11 to noon. Actually, from 10 to noon. And I will see you again this time next week. And I hope you have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.